Good morning, everyone. Good morning. Hi. Hi, good morning. My name's Jonathan Crane, and I want to welcome everyone to the KraneShares China A-Share Inclusion Roadshow. Thank you very much for attending today. I want to thank our partners MSCI and CICC who are speaking today. The upcoming MSCI China A-Share inclusion into global indexes will be a historical moment in asset management history. It will be the first time that the China A-Share market, the Shanghai and Shenzhen exchanges, which makes up the second largest equity market in the world, will be included into global indexes. I lived in China for about 5 years and quickly discovered many long-term positive growth trends and opportunities while building a company there. When I returned to the U.S., I believed that China would become a much more important allocation in U.S. portfolios. We started KraneShares 5 years ago with a singular focus on China and providing U.S. investors with the best education, products, and access to one of the largest and fastest growing economies and markets in the world. With the MSCI China A inclusion first implementation happening on June 1st, 2018, we thought it would be valuable to provide clients across the U.S. with an opportunity to receive in-depth analysis on this important event. Again, welcome, and I hope you find this morning's program to be productive and impactful for your business and investing. Thank you very much. Brendan?
Thank you, John. My name is Brendan Ahern. I'm the Chief Investment Officer of KraneShares, and just reiterate John's welcoming comments. We want to dive right in. We're very privileged to have Kevin Liu joining us from China International Capital Corporation. China's in the news a lot, and I can't think of a better person than Kevin, who we've known for many years. He's an equity strategist, really is the right-hand man of Dr. Liu, their chief economist. And certainly, I think even just overnight, Kevin, you've had a positive effect on markets. But there's a lot of China news coming. DD, a proposed IPO, potential reserve requirement ratio, and I think the collaboration between KraneShares and CICC. There's not going to be a better firm to help provide a balanced perspective on what's taking place in China on a daily basis. And with that, I welcome Kevin.
Thank you. Good morning, everyone. My name is Kevin, equity strategist from CICC. Today, I'm very honored to stand here to share with you our views on the China market and outlook and economy outlook. I know there has been a lot of discussions and news report with regard to China, especially given the fact that the trend tension between U.S. and China right now is heating up. And there are no lack of very bearish tones. But in general, in our views, we believe China market will be stronger for longer for this year. Let me show you some of our, the rationales behind our positive views in my slides. Will be elaborated in the following sections. But let me start with one chart to show where China actually is standing right now, in our opinion. We think China right now is probably entering a secular uptrend cycle after years of slowdown and consolidation since the global financial crisis. It's kind of a similar, probably, as 2002 to 2007. Of course, it's not going to be exactly the same, but we believe right now it's right at the edge of another uptrend cycle for both the economy and the market performance. Before I explain in depth why we believe this, let me take a let's take a few look at the what's going on right now in the near term. As you may already be aware of, Chinese market, both the onshore and offshore, onshore H-share and offshore H-share market has been experienced some consolidations due to the worries of trade tensions and also slowdown of the growth momentum in the near term, and also worries with regard to the policy uncertainties. But we think the overall near-term worries could be a little bit overdone Because if you check all those high frequent indicators as I show on these slides, for example, the PMI, the coal consumptions, the cement price, and also the steel of inventory, you don't have to go too much detail into this, but the conclusion I want to show you is that the underlying demands, the underlying fundamentals are still resilient. For example, yesterday, the Politburo meeting sent very positive signals, helping to elevate the very relatively bearish sentiments to say that they want to maintain the stability of the overall economic growth this year. That's why we see a very notable price performance in the Asia market yesterday. So we think overall this year, the economic growth will be still resilient. We expect China will probably deliver like 7% year-over-year GDP growth. That is actually accelerating compared to what we have experienced in 2017, rather than slow down. I know majority of the street analysts expect that this year China will probably slow down due to a high base, due to the exit of monetary easing and also various financial deleveraging effects. But we think otherwise. Thinking about that, 7% GDP, real GDP growth, together with an inflationary environment, it will give you like double-digit nominal GDP growth, which will translate directly into the robust corporate revenue growth. Why we think that? One of the key rationales behind our relatively positive and also anti-consensus call is that we believe the property market will still hold up well in 2018. Why is that? There are two reasons. You can see the chart on the left. That is the inventory across the country, across different cities. It's at multi-year low levels, meaning that there are restocking needs. And not to mention that due to the policy concerns of the surging property prices, there are barely almost zero land supply in certain tier 1 cities. There's a jump in land transactions so far this year for the first couple months, which is usually the leading indicator for the property new starts and investments. I'm not here to argue a very super strong property investment this year, but we don't think it's going to be a major drag or even to see a crash scenario in the property market this year either. To continue to deliver a resilient growth in investment to support the overall economic growth. And another bright spot for this year could come from the manufacturing investment. You can see from this chart the corporate capital expenditure for the new economy sector, which is the orange line, already started to pick up in 2014. And even the old economy sectors, thanks to the supply side reform, you have better revenue, you have better demands, already also started to pick up since the second half of 2016. If this trend could continue, and we expect it to do so, will be another driver for the overall economic growth. And that's also a very important reason why I believe I will explain to you later for the corporate earnings growth, one of the key drivers behind this. When we talk about China, a lot of first impression for global investors will be on the for the chart on the left. That is, China is slowing down continuously after the financial crisis. You see, that's where we stand right now. It's continually slowing down in terms of GDP growth. But most of as per our communication with various clients, most investors tend to neglect the fact that there has been a very dramatic transition of growth model within the whole economy. Meaning that you can see from the divergence of the orange line and the gray line, which are investment-driven sectors and also service sectors. The service sectors, all the new economy sectors, are continue to gain shares at the cost of the traditional investment-driven sectors. That means even you see a slowdown in economic growth, but the overall growth quality is actually improving. This has been reflected in their corporate profitability the new and old economy sectors, the ROE level right now, you can see the divergence is very notable between those two. And also the stock market composition. That's for the A-share and offshore S-share market. It's kind of a changing, already reflect the growth transition in the whole economy. Not to mention what we have seen from the stock market performance. If we construct a basket of new and old economy sectors, you can see it will give you very different price performance over the past few years. And if we take an even longer perspective wells towards China, I know a lot of global investors, especially long-term value investors, if you really want to put your money in China, one of the key questions you probably ask is that, despite all those short-term turbulence or volatility in the next 3 months, what could be the real long-term driver for China as such a big economy? You can see from this chart, at every inflection point, there are major policies reforms to be introduced to help China be able to deliver or unleash the growth potential for the next decade. Standing right here, we believe the continuation of urbanization will be the next one. Let me show you some numbers for this. So right now, the official urbanization ratio is roughly around 60%. That is about Japan's level back to 1960s. And if you measure that by population, hold a household registration, or called 户口 in China, meaning that you can only enjoy the big city's social welfare with that, the ratio will drop to only 40%. Thinking about that, half the China population, which is 75 million people, they still live in the rural area. If in the next couple of years, only half of that, starting to reallocate or moving into cities, how much big demands it will generate, for example, consumptions, housing markets, even a better car. That's going to be huge demands for the domestic economic driver for the long term. And there are also already well-built infrastructure we call 2 super networks to facilitate such progress. One being the high-speed railway network. For example, those workers from the rural area, we call the migrant workers in the big cities, they can never afford a apartment in Beijing, for example. But if their hometown is only, for example, 170 miles away from Beijing, this high-speed railway only costs you 1 hour travel from Beijing to their hometown. They can afford a very decent house back to their hometown. That's also the reason why we see very notable property market price hike in those so-called Tier 3 and Tier 4 cities to improve or to make the labor mobility much easier. The other will be the mobile internet penetrations or the mobile internet network. Even the far-reaching small cities, it's very easy right now to do the e-commerce. And China already now is entering a so-called cash-free society. You don't have to carry any cash. You just use your smartphones, use your WeChat. You can pay anything, literally anything, in the big cities. It's very convenient right now. So along with such long-term trend, we believe in China right now, there are probably 3 major investment opportunities. In the mid to long runs, 3 major investment opportunities. One being the consumption upgrade. For obvious reasons I have explained previously, more people to enjoy better life, better car, and better house. So that's going to be a huge demand for this. You can see all those names are listed here, those homegrown brands, they're all going to benefit from this. The other trend will be investment opportunities will be the manufacturing upgrade, because the government is actually pushing forward on this as a strategic goals. They want to build up their own manufacturing, especially high-end manufacturing brands, rather than just outsourcing to produce all those shirts and low-end manufacturers. So those kind of names, as you can see from here, like manufacturers for cars and also for machinery and even the high-speed trains manufacturers are going to benefit from this. The third investment opportunity comes from the oil economy consolidation. You may wonder why we still want to invest in this, because those sectors tend to be inefficient and over capacity. But if you compare the current concentration ratio on the chart on the left, you can see that that's very low compared to their counterparts in US and even Japan. What China's oil economy sector is experiencing right now is similar as we probably already see in the States and also in Japan back to 1980s. That will help to improve the efficiency of the companies and also to phase out the outdated capacities. Not to mention you can also lift the valuations. So giving all those background of the macro environment and also the macro long-term trend of China, we believe at least for this year, both A and H shares, or put in other words, China's corporate can deliver a still very resilient double-digit earnings growth this year, driven by two factors. One being their still notable revenue growth against the backdrop of nominal GDP growth, and the other being better margin thanks to the increasing bargaining power due to the recovery of the demand. That can also be seen from the market consensus revision. It's being revised up continuously, especially for those oil economy sectors, because you see more profit coming and even better cash flow and higher profitability, which is ROE we can see from this chart. And H-share market is even stronger in growth because it has higher concentration in cyclical sector and also financials. Certain investors probably still concerned about the leverage or the debt problem of Chinese corporate sector. You can see from this chart on the right bottom chart of this H-share market leverage, yes, overall it's still increasing, the overall financial leverage of the Chinese corporate sector. But there are two different angles to look into this. One being that you have to bear in mind that 2/3 of the overall corporate debt is held by SOEs, which are partially guaranteed by the government. The second angle is that if you exclude all the cash and the cash equivalents, which is the blue line shown on the chart, the right bottom chart, it started to decline since mid-2014. And we see better cash flow, we see better interest expense coverage. So overall, the balance sheet is in better shape for Chinese corporate. And also the H shares earning revision is being continuous in the upward trend as well. The other question investor might ask is the financial cost. Because the exit of the monetary easing, the financial deleveraging has pushed up the real economy financial cost a little bit. But if you compare that with the profitability or the ROE level of both on and offshore Chinese companies, you see that actually improved much faster. So the widening spread between the profitability and the borrowing cost make the corporate profitability can still sustain going forward. That's what we've seen back to 2002 as well. So given all those analyses, overall we expect a double-digit earnings growth this year, together with valuations expansion, re-rating potentials in both A and H share market, which I will show you all the charts later. You will probably have decent like 20% of market upsides from this level. 10 to 15% from the earnings growth, another 10% from the valuation expansion. Liquidity-wise, for Asia market right now, it's kind of a changing also a little bit right now, because we see after the year-end liquidity tightening session after 2017, in marginally the bond yield curve has been steepening, which is usually a good sign of the market liquidity perspectives, and which usually bodes well for the market performance as well. And not to mention that the continuous strength in RMB against the dollar has turned around the capital outflow trends. We already seen very notable capital inflows, while the northbound of Stock Connect recently, continuous and accelerating inflows recently. One could be, one of the reasons behind this could be the, a lingering and looming approaching of the MSCI inclusion. But we also see continuous inflows to the Hong Kong market as well, to the offshore listed Chinese company, and it's accelerating so far this year. It's been like a very strong inflows, as you can see from this chart. On the for the chart on the right-hand side, you can see that for global funds right now, they are still underweighting China, although it has recovered notably since 2016. But right now, at this point of time, they are still underweighting China, meaning that if such return expectation or the worries with regard to China's economy gradually, being alleviated and gradually improved, it's gonna bring more funds into the Chinese market. As you can see from the chart on the left, thus surge inflows just happened at the beginning of this year, right at the first few months of this year. That's the continuous inflow. Not to mention the northbound and southbound, they both play very important roles already on both markets, and we see continuous inflows recently, to both sides. Valuation-wise, is also very attractive if you compare Asian market to global peers. They are trading roughly around, for those blue chips, roughly around 11 or even 10 times of PE ratio. And certain blue chips, for example, banks are trading at 0.8 price to book ratio right now. If you compare that to the counterparts in the United States, in S&P, if not to mention, you still have very resilient earnings growth. And those charts, I won't go too much into details, but they all show the similar story that valuations are very attractive and very low at this point of time, no matter if you compare to the historical level and also to the global comparison with the other global markets you can access to. There are certain risk factors you should, worth noting. For example, the surging inflation, unexpected high inflation would cause pressure on the monetary policy, all the house market slowdown, or even the financial deleveraging and also trade tensions between China and US. But all of those, in our best case scenario, we think are still manageable. One of the commonly asked question comes from the chart on the right. I will spend a little bit more time to explain this. That is the overall leverage or debt to GDP ratio of China. You can see from the red line, it's climbing very fast after the financial crisis. That's also one of the biggest concerns as per our communication with global investors. They always ask, okay, you have the surging debt burden, you have the increasing financial leverage. How can you, manage that? Or is it kind of really sustainable? Will it be a systematic risk for the overall economy? Put in short, we believe right now, standing at this point, although it's, we should pay special attention to this, but it will not be an immediate threat to the overall economy. There are two reasons behind this. First, we have to understand the overall structure of the different sectors in China. Household and the government sector in China, they are still in net cash position. The corporate sector is more, the problem for the corporate sector is much higher. I mean, the overall leverage. But as I just mentioned, 2/3 of the debt are held by SOE sectors. So it's partially guaranteed by the overall government. And one of the commonly made mistakes for global investors to look into the debt problem in China is that they usually directly apply the methodology used in developed markets into China. But you have to understand that there's very unique structure of China's, all those kind of central government has very strong influence, not only for the corporate sector, SOE sector, and also the banking system. So they have a strong control of all this. So that's why we believe it's not going to be a very dramatic, systematic risk right now. The other being the trade tension, trade frictions between US. Overall, we believe the impacts could be still manageable. Thinking about the overall value of the tariff right now, $50 billion US, it's roughly only 0.5% of the overall GDP of China. So it really actually won't pose too much direct threat to the GDP growth. And to the worst case scenario, China still has a lot of tools available to boost domestic demands. And it also chooses to respond positively by opening up general manufacturing and lower the barriers for the entrance of foreign investors, for example, in the financial industry and also other industries. I think, yes, there are still tensions going forward, but overall, we think it's still kind of be manageable, the overall impacts. But yes, certain sectors that has higher exposure, as I can show from here, see from these slides, will be relatively more vulnerable if the tension is heating up continuously. But overall impacts we think is still manageable. The last but least thing is the MSCI inclusion. I think our next speaker will have more insights on this. But from my perspective, we think it's a very big thing. It's a very big milestone, very big thing for the Asian market. Although the initial inclusion percentage is not that much, it's only 5%, but it marks a very important milestone for Chinese market. How to play with it? There are two ways. First, you can buy a basket of it. And you can see from various perspectives, they are attractive in valuations, even considering, even more attractive considering their overall earnings growth. The second way to play with it is to find alpha from the valuation discounts. If you look at the Korean and South Korea and the Taiwan's example back to 1990s, before their inclusion, all those sectors with a very notable valuation discounts to global peers tends to outperform the overall market 3 to 12 months horizon after the inclusion. That's the way how you find the alpha. But even for the overall inclusion baskets, it's going to be attractive right now, in terms of all those growth potentials and valuations. So yes, I'm gonna stop here because I'm already running out of time. I won't take too much time for this. There are also Q&A session later. So thanks again, everyone, and thanks, Jonathan, for the invitation. It's really a great honor to be here. Thank you. Yeah.
Thank you, Kevin. All right. Okay, thank you, Kevin. And we will have Q&A at the end of the presentation. So next, we're going to have Abhishek Gupta from MSCI's Equity Research Solution team. We're privileged to have Christine and Michael joining us from MSCI as well. Certainly our partnership with MSCI has been over 4 years now. And I think it's important that with the growth of passive investing, that it's my belief that the most important firm in finance today is MSCI because their index methodologies now dictate over 12.5 trillion. With that, I'll hand things off to Abhishek.
Hello. Yeah. Thanks, Brendan, and thanks, Jonathan, and thanks to the KraneShares team for the invitation here. I am Abhishek Gupta, representing MSCI, and I'm a vice president at the Equity Solutions Research team, and have been with the firm for nearly 8 years now. I'm extremely delighted to be present here at this event, at the in the New York Stock Exchange, speaking to you all and presenting on the evolution of China A shares and the MSCI China A Inclusion Index. It's an exciting time for us, and the inclusion of China A shares. I'm sure that the same level of excitement is shared by our clients from the global investment community, as well as our partners, KraneShares and CICC. Yeah, I got this working. I'm sure that many of you are already aware of MSCI, but for those who are not, we power better investment decisions through innovations in differentiated content, flexible technologies, and actionable solutions. And two such topics that we are discussing today is the MSCI market classification framework, which is really the background for the evolving methodologies, as well as the MSCI China A Inclusion Index. Now, roughly $12.4 trillion of assets are currently benchmarked to MSCI indexes, and roughly a monthly average of like $775 billion in ETFs that are linked to MSCI indexes. Now, in all of this, our clients and our partners, they rely heavily on us for the high quality of the data, for the innovation that underlies some of our index methodologies, the robustness of our risk models, as well as analytical solutions. Now, throughout this investment process for any typical institutional investors, starting from making policy level decisions or allocating mandates or running performance calculations or performance attribution, for instance. Now, MSCI has several touch points with all our clients. We engage with our clients throughout this process and assist them in their investment decision making. So with that background, maybe let's now talk about the MSCI Global Index family. Now, China, and in a few weeks from now, China A, they're an integral part of the MSCI Global Index family. The MSCI ACWI IMI Index is our flagship index. It's an acronym for All Country World Investable Market Index. And it comprises developed and emerging markets and have large, mid, and small-sized companies. So really the full equity opportunity set. Now, roughly of the $12.4 trillion that I mentioned in my previous slide, $3.2 trillion are linked to the MSCI ACWI Index Suite, and $1.6 trillion is benchmarked to the MSCI Emerging Market Indexes. Our indexes are, our ACWI IMI index is modern because it reflects the current dynamic of the marketplace. It kind of changes with the way the methodologies evolve. It kind of reflects an investor's experience. Our methodologies are seamless because there are no gaps or overlaps in our size segmentation of the gig sectors. And they are integrated and consistent in the way they are applied across geographies with specific emphasis on investability and replicability. So I spoke about the way our methodologies evolve, and at the heart of that process is the MSCI Market Classification Framework. Now, it's an annual process where we reach out to clients, seek their feedback on the markets that we place under review for a potential reclassification. During this process, we speak to like thousands of investors of all types and sizes, and also speak to regulators, connect with exchanges, get all of their feedback, consolidate all of that, assimilate all of that knowledge, and then communicate back to the market our findings and our decision on that potential reclassification. For any country to be eligible into, say, an MSCI developed market or emerging market or even frontier markets, they need to meet certain eligibility criteria, some minimum set of requirements, if you like. For China A, we have applied a lot of screens on the size and liquidity. So we believe that the current China A securities that are actually making it into the MSCI Global Equity Indexes are investable. We also apply market accessibility to gauge the level of accessibility of those shares by global investors. On market accessibility per se, specifically, we look at like 18 measures. And some of the key ones are listed on the slide here. For instance, openness to foreign ownership. Now, there should be no discrimination between a local investor and an international investor, ideally. The ease of capital mobility. How quickly can you move money in and out of the market? Are there any limits on repatriation? So these are some of the important considerations when any global investor is looking at investing. And so these are things that we have incorporated in our China A inclusion. So as you can see, it's a very busy slide. As you can see from the infographic, this timeline, this tells you the journey of the inclusion of China A into MSCI Global Equity Indexes. We opened up the first round of consultation back in 2013, reaching out to clients, soliciting feedback. In 2014, we did not include. Actually, throughout this timeline, we acknowledged that there were significant improvements in the way the China A shares could be accessed. However, there were hurdles, back in those days. So in 2014, we decided to not include. In 2015, we again decided to not include, even when there. So some of the issues that were kind of staring at investors at that time was the quota allocation. So there were investors were looking for a more streamlined access to shares. The size of the quota should be commensurate to the size of the investors, and so on and so forth. There were also limits on capital mobility, on the capital lockup, on the amount of money that an investor could repatriate at a given point in time. So given all those considerations, MSCI, because we reflect investors' experience, we chose to not include MSCI China A shares. Sorry, the China A shares. In fact, something very significant in the year of 2015 that happened was that MSCI came along with CSRC, the China Securities Regulatory Commission, and the two jointly launched a working group together. The aim behind having such a working group was to facilitate discussion and progression around some of the issues that prevented the inclusion of China A shares. Now, MSCI was the only index provider to have had such a working relationship with the Chinese regulatory authority. So come 2016, again, there were significant improvements. However, there were still concerns around the monthly repatriation limit or the pre-approval requirements for launching indexes that were linked to, launching products that were linked to indexes. Now, 1 year fast forward, 2017, is when MSCI announced its decision with a plan and a timeline for the inclusion of China A shares. Our decision received broad support by the global investment community because there were significant improvements that had happened through the Stock Connect program, as well as the accessibility of the shares and the loosening of the pre-approval requirements with respect to launching products on indexes. In 2018, which is coming in like a month from now, in the month of May, is when we will be announcing the final list of constituents, and that will coincide with the May 2018 semi-annual index review. And some more insights on that on this slide. So what exactly is the impact of this inclusion? To start with, firstly, only the China A large cap securities are getting included at this point in time, and all of these securities will be Stock Connect compliant. So investors can easily trade into them through the Stock Connect channel. Now, the inclusion will happen in two phases. The first in May index review and the one in the upcoming August index review. In May, we will be including 2.5% of the free float market capitalization of China A shares, and in August, we will subsequently include another 2.5%. Now, these percentages, they kind of reflect they take into account the daily trading limit that still is a concern, for investors, if they were to invest more than 5%. As you can see, there are two pie charts. The one to the left shows the May SAIR impact. The one to the right shows the August SAIR impact. And China already forms like a third of the emerging market index. And with the inclusion of China A shares, the weights will only increase. So now for those who are looking at a longer term view on what eventually, how the road looks like going ahead. On this slide, we have two snapshots. The one to the left shows the current MSCI emerging market index. its breakdown, and the one to the right shows the emerging markets with a full inclusion of China A shares. So as you can see that the weight increases from like roughly 30% to more than 40%, which is very significant. Now, of course, however, this inclusion, this full inclusion is subject to a lot of considerations. So for instance, the resilience of the Stock Connect program, the alignment of the accessibility of China A shares with international standards, the progress on trading suspension. So all of these factors have to come together and then MSCI would continue to monitor the situation, roll out public consultations, solicit feedback, and then announce decision on any further inclusion. But as we see, the inclusion will likely be more gradual than a full-blown. So now looking at, say, the MSCI China A Inclusion Index, this is a very innovative and dynamic index which kind of at any point in time reflects the inclusion of China A shares. The inclusion captures that specific set of securities that will be included into the MSCI Global Equity Indexes, the one that we saw in our pie chart on the previous slides. All of these securities will be accessible through the Stock Connect program. The China A Inclusion Index is a subset of the China A International Index, which included mid-caps and non-Stock Connect securities. But China A Inclusion Index is the one that kind of fully reflects the securities that are entering the global equity indexes of MSCI. So what does the, some further insight on China A Inclusion Index, the sector decomposition of the top 10 constituents. So I think even Kevin alluded to in his presentation, financials and industrials, they're kind of the largest sectors here. They carry the largest weight. However, the top 10 constituents have representation from diversified sectors. So, and something very interesting to note, and I'm sure that most of you are already aware of this, that the way the China A market has been growing, it's been growing at roughly a rate of 1 IPO per day, over the last couple of years. And so with more and more, with this trend following, we only see that the sector breakdown or the top 10 constituents could kind of look slightly different from they are today. So how does it look like going forward? China is an extremely important market. We are taking this first big step as well as our global investors are taking this first step of inclusion of China A shares into MSCI Global Equity Indexes. For now, we are including 5% of the total free float market capitalization, which though may be small, but still gives you that channel or that access to invest into the China A market, the mainland Chinese equity markets. A full inclusion could still be a few years away from now. However, it also has kind of critical implications. So investors are looking more and more towards falling in line and including China A shares into their portfolios right away than kind of wait out later and then include them at a later point. So inclusion of China A shares also leads to the expansion of the universe, a larger, broader equity opportunity set. So yeah, I think like at MSCI we are extremely committed to doing our research on China. It's not a small undertaking, and we realize that we will continue to have discussions with market participants, reach out to them, solicit feedback, and continue to monitor the situation for any further inclusion of the China A shares. I think with that, I would kind of conclude my presentation. I'm right on time. So thank you all for hearing me, and I think the Q&As are later, right? Yeah, okay. Back to you.
Okay, thank you, Abhishek. My job right now is to basically take Abhishek and Kevin's presentations, kind of meld it into what we see from a KraneShares perspective. And just, I'll use this opportunity maybe just to quickly introduce a little bit about ourselves. That Jonathan is being very humbled. Jonathan built the company after living in China, and where he formed kind of two core theses. The first was that China was evolving its economy away from traditional drivers like banking, industrials, basic materials, to new China thematics such as clean energy, technology, healthcare, internet, and e-commerce. Secondarily, he saw how the door into China was starting to open, that the access into the mainland markets, that door was just starting to crack open. And when he came back to the United States and saw how China ETFs were really geared to not only kind of old China, but no mainland access, he started down the path of creating KraneShares. And you fast forward today, we have a great partnership with China International Capital Corporation. Clients have entrusted us with over $2 billion in assets. And I think we're just getting started because Jonathan's ultimate vision is really coming to fruition. Now, I think what's important about this underinvestment in China is if we all know that the United States is the largest economy in the world, right? And it's not surprising that as the largest economy in the world, within the MSCI All-Country World Index, the largest index for pensions, foundations, endowments, it's not surprising that the United States is the largest weight. But China, we know, is the second largest economy in the world. But what weight is China within the All-Country World Index? It's actually under 4%. So an investor today has more exposure to Japan, twice the exposure to Japan, even though their economy is half the size of China's. And they have approximately the same weight to the United Kingdom and France, even though their GDPs are 1/4 the size of China. Now, the reason for this historical underinvestment is that the definition of China has been just 150 Chinese companies listed in Hong Kong. Now, back in 2016, we had the addition of US-listed Chinese companies to MSCI indices. But we can see that this bigger piece of the pie, the Chinese A-share, the Shanghai and Shenzhen market, is considerably bigger than the Hong Kong and US market, and it's been excluded from MSCI indices, and for good reason, which has been the historical lack of access. And over the course of the last really 2 decades, we've seen an evolution of access. It's kind of funny how a lot of times we apply our standards to China and other emerging markets, but the reality is the Shanghai and Shenzhen stock exchanges weren't even started until 1990. We actually had met a gentleman who visited the Shenzhen Stock Exchange in 1995. Can anyone guess how many stocks were trading on the exchange at that time? 5. There were 5 stocks trading. So the exchanges weren't started until 1990, kind of apropos. Here we are at the Buttonwood Tree, dating back to 1780 or thereabouts. The first foreign investors weren't allowed into China's equity market until 2002 with the launch of the Qualified Foreign Institutional Investor Quota Program. So China allowed 170 buy and hold long-term strategic investors into the market for the first time. These investors included all of the great schools I wasn't able to get into coming out of high school. Harvard, Yale, Princeton, Duke, a lot of Canadian pension plans like Ontario Teachers, Casa Depot, Bill and Melinda Gates. Those 170 investors today have about $80 billion invested in mainland China. Again, aggregate market cap, $8 trillion and only $80 billion. Now, from studying China, China moves in incremental and pragmatic steps. They never pull the Band-Aid. And so China spent 10 years studying how these QFIs were investing in China. And then fast forward to 2011, they launched our QFI. Now, our QFII allowed for daily liquidity. So QFII, you could only get your money in and out once a month. Our QFII on a daily basis. Now, again, in the China format of incremental and pragmatic, that our QFII was only given to Chinese asset managers based in Hong Kong. And that was, in case this didn't work out, you could turn it off. It's at that time that John and I, in 2013, that we went to Beijing and met with the CSRC, the SEC of China, the State Administration of Foreign Exchange, with the idea of listing a RQFI ETF here on the New York Stock Exchange, and that was enthusiastically supported by the regulatory bodies, and ultimately we were able to partner with MSCI to license what's become our KBA, or MSCI China A ETF. Other foreign asset managers were given RQFI status. And then most importantly in 2014 was Shanghai Hong Kong Stock Connect, which allowed for the first time an institutional investor to set up an institutional brokerage account and trade onshore. 2016, Shenzhen Hong Kong Stock Connect. And that's ultimately what allowed MSCI to start this inclusion process, is that we've had this trajectory, this evolution of access over 20 years to get to where we are today. And it's ultimately a big reason why we've been building this business in preparation. Now, over that same time period, there's been an incredible phenomenon. The growth of passive investments. Exchange-traded funds today have almost $5 trillion in assets invested in them. This past Saturday in the Wall Street Journal, Jason Zweig, he writes the Intelligent Investor column. It's a great column. And he talked about how the largest index provider here in the United States has $4.1 trillion in index funds. This number 2 index fund provider here in the US has $3.4 trillion. That's just 2 firms. That's over, we can do the math. $7 trillion between those 2 firms. You have another $5 trillion. And that's why I believe the most important company in finance today is MSCI. That MSCI's global investable index methodology, there's 185 pages now dictate over 12 trillion in assets. And as much as we've adopted exchange-traded funds, how well do we understand the nuances of these index methodologies that control what those ETFs and those index funds own and don't own? Because the end reality is those index fund families, they don't determine what stocks they're going to buy or sell. There's CEO, CIO, portfolio managers, and traders. It's the index methodologies supported by MSCI. And so I think the next evolution of ETF growth is going to be the evolution of index methodology study. So historically, there's actually only been 3 countries added to MSCI emerging markets. And what happens is MSCI makes an announcement and they give the global asset management community 1 year to get ready for it. So back in 2013, they announced that Qatar and UAE would be added to MSCI indices, including emerging markets. And more recently, we had Pakistan added. Now, what's important about these inclusions is these were one-time, very de minimis, very small additions to MSCI's indices. And yet we saw that market anticipating for the inclusion. And since June 20th of last year, we've had a similar effect where the KBA has actually outperformed the S&P 500 since June 20th, when MSCI made the announcement about the June 1st inclusion of the Chinese A shares that we hold in KBA. It's a very specific definition. We're not adding all 3,500 stocks in China. To Abhishek's point, we're adding 235 large cap stocks that comprise our index. So how do we know that this performance in KBA isn't just the China market going up? So we're talking about large cap stocks meet the MSCI definition. Shenzhen Composite is predominantly mid cap and small caps, and there are some large cap stocks, but predominantly. KBA outperformed the Shenzhen Composite over this time period from September 20th to last night's close by 7 times, which means people are understanding that not all of China is going to be going into portfolios. It's a specific definition, which is why we've always been so specific about working with MSCI. And what I believe, so we have a small inclusion beginning this June 1st and September 1st, and I believe over the next several years, you'll see a semi-annual dial-up of the MSCI China A Inclusion Index, which we're benchmarked to, and that ultimately gets us to where we know we're headed. That we know that, yes, this summer's inclusion starts small, but we know that that trajectory gets us to 17% more China within MSCI emerging markets. It also affects MSCI's full suite of indices like All Country World, All Country World X, Asia X Japan, anything that holds China, which is ultimately why we built our business, is because we're going to need a partner to help us navigate China and what's happening there on a day-to-day basis, because we're going to own a lot more of it. And the bond market, Bloomberg Barclays announced in March that the China's bond market is going to go into their fixed income indices. So China's bond market is the 3rd largest bond market in the world. The aggregate exposure in the 3 largest benchmarks, the Bloomberg Barclays Global Ag, City Sovereign, JPEM debt, is 0. Is literally 0. What happens when the 3rd largest bond market in the world goes into JPEM debt? 1/3 of the index. So what are we actually getting access to? So as stated, when we looked at our holdings and we ran it against the decile market cap, we can see we hold the largest companies in China. These are also very liquid names. Here on the New York Stock Exchange yesterday, a company called McDermott was the most heavily traded stock. It traded 70 million shares, 71 million shares. It wouldn't have been in the top 30 in China. The largest stock, most heavily traded stock in China last night traded 1 billion shares. McDermott would be the 30th most heavily traded stock in China. Hopefully none of our friends from the New York Stock Exchange are here. So we know we're getting these mega cap, large cap names. Bloomberg has a great tool called ETF liquidity, where they say how much money can you put into an ETF before you move the underlying stock. In the case of KBA, you could do almost 20 million shares, a value of $600 million into KBA before we become more than 25% of any of the underlying stocks' average trading volume. Hopefully someone will take us up on that. So the one aspect about we're understanding why MSCI, we know why MSCI has kept these securities out of their indices. It's been the lack of access that's slowly been solved over the nearly last 2 decades. And one of the benefits of this ring-fenced from global markets is a very low correlation. That this market just acts differently than other markets because it's not part of globalized fund flows. So that's an important benefit from a portfolio perspective because that's very difficult to find. And I think another thing, one of the things that Kevin really stressed was that this market is trading at historical valuation discounts to long-run averages. The forward-looking PE within KBA it's actually under 11. So the current PE is in line with broad-based EM, which is at a significant discount to equities here in the United States. But when we take Kevin's points about earnings growth in China, that makes our forward-looking PE at quite a bit of a discount. So if you're thinking about the potential shift from growth to value, we certainly believe KBA and China is a great opportunity from a rebalancing perspective. And one of the benefits of this lower correlation is that it helps minimize the aggregate volatility of one's portfolio, simply because it's kind of a yin and yang, right? It's this market is acting differently than the other equity asset classes you own. And this is exactly why we listed KBA over 4 years ago. Since then, KBA has grown to be the largest MSCI China A ETF globally. We now have a 4-year track record. And certainly we're very much excited about what's going to be happening over the next several years, because ultimately we know we can skate to where the puck is going, was always Wayne Gretzky's famous saying, right? And we know that China is going to be a bigger and bigger part of portfolios, regardless of if you're an active or passive investor. It's going to get significantly larger. And certainly we hope that the largest void we can fill is providing a balanced perspective on what's happening in China on a day-to-day basis. I'm glad everyone's sitting, because as much as Abhishek talked about how China at about 30% today will grow to 40%, it's my belief, if we look even further afield, South Korea and Taiwan make up mid to low teens within MSCI emerging markets. Now, what determines developed versus emerging markets? One of the primary criteria is actually GDP per capita, which both South Korea and Taiwan meet. They meet developed market status, but they've not been upgraded as of yet due to certain trading and currency restrictions. But it's my belief, and one of the reasons that I quit my job to be part of building KraneShares is because not only, to Abhishek's point, China will be going from 30 to 40%. If South Korea gets upgraded from EM to developed, the redistribution means China goes to 50%. If Taiwan also gets upgraded, right? China 30% today, will be 40. South Korea goes 50. Taiwan goes, China's 60%. And people said, Brendan, there's no way China can end up being 60% of MSCI emerging markets. It's just too big. But in 1980, Japan was about 30% of IFA, of MSCI developed markets. And where did Japan end the decade? At almost 60%. So we believe that just as Japan had opened up and liberalized their markets and their currency, China's headed down the same path, which, again, is my belief. In 3 to 5 years, China will be approximately 40% from today's 30%. And potentially within a decade's time, it could be upwards of 50 or 60%. And again, this is part of the reason why we built the company. It's not just to provide the product that represents this specific definition of 235 stocks, but also to help you as investors be able to make educated investment decisions on behalf of your clients and your end portfolios.